Last week, we had another PPC Ian dividend investing meetup. This time it was in the greater Sacramento area in Elk Grove, California, and it was really a good meetup. I had 4 community members show up, so there were 5 of us, including myself, and we spent an hour and a half or so discussing dividend stocks. Of course, it was at Starbucks, none other than Starbucks, one of my favorite dividend companies of all time. And it seemed like the consensus of the group there is that others liked Starbucks both as a place to enjoy coffee as well as to invest in as well. And I want to take the opportunity today to summarize some of the insights that I gathered from the meeting. Because I will tell you, one of my favorite things about this YouTube channel and this community overall is there is some serious brain power here. So I quickly noticed this at the meeting. Everyone brought their A game. And in fact, one of the attendees is actually a PhD candidate right now as well. And so there was some serious brain power in the room, a lot of stuff that we went through. I want to share some of those insights in the video today, but I also want to take the opportunity today to answer one of the team members' questions. I had someone at the meetup say, Ian, one of the stocks that you own, Cedar Fair, he pulled out his phone and, hey, they just raised the distribution, the dividend. They called it distribution because it's a master limited partnership. They just raised it, but it was only 1%. What do you think about that? Well, I left the meeting and I had some answers during the meeting, but I left the meeting. I'm like, hey, I want to take a deeper look at Cedar Fair. It's one of my top 15 favorite dividend stocks of all time. I want to take a closer look at it, see what's going on, see why the distribution only went up by 1%, because it wasn't a very big increase. And so I'm going to share with you today some financial analysis, as I always do, as I really enjoy doing. We're going to dig down into some of the numbers to get to the nuts and bolts of dividend investing. So get ready, everyone. It is going to be a really exciting video. And first and foremost, I just want to thank everyone who attended the meetup. And if you want to attend meetups in the greater California area, I have had meetups now in the greater SF Bay area, now in the greater Sacramento area. I plan on doing more. I will include a link in the description below so that you can sign up for my local crew. And the local crew these days, it's not only about the Bay Area. If you're in California, you may want to sign up for that local crew list so that you're apprised of meetups that may happen anywhere in California. All right, everyone, let's jump into it. Another dividend investing video. All right, so I'm going to start with some of the practical stuff first, some of the high-level stuff that we discussed at the meetup, and I'll get into the technical stuff at the end of the video today, all the financial analysis. Topic 1, the first thing we discussed at the meeting was this concept of investing in trends. One of the community members who showed up, he brought this very unique vision, this very unique perspective on stock market investing, and he said, hey, I've been revamping my portfolio, I've been thinking about the future of my portfolio. And the way that he's looking at things towards the future is not only investing in really strong companies, but making sure that those strong companies are aligned with the trends. And so some of the trends that we discussed, for example, was the lithium trend. And so obviously there is this movement, if you will, in our society towards batteries. And we're talking about batteries in automobiles. We're talking about batteries in homes, such as a backup battery or powering your home with solar and having that battery attached to it. And so there's this movement towards battery power. And obviously to create these batteries, you start thinking about natural resources and you start thinking, hey, is the best bet to invest in traditional oil super majors like I do? I own Chevron, for example, and a bunch of others. And even the one of the interesting things that came up in this discussion was Aramco, the Saudi company or the Saudi national organization known as Aramco, one of the biggest oil producers in the world. They are basically going to IPO soon here. And so the question goes, Is that the right trend, or is it a better trend to invest in lithium, which is used in producing batteries? And so we started talking about some lithium companies, two that actually came up. The first was this company, Albemarle Corporation. I don't know if I'm saying that right, ticker symbol ALB. And another one that came up was the Global X Lithium and Battery ETF, ticker LIT. So that's an ETF. It's a composition of different companies. And so these two came up. Personally, I don't invest in any lithium companies. I have gone the more traditional route in oil super majors because I tend to believe that oil is still going to be in our future because it's used in so many applications and our global population continues to increase. There's going to be more and more demand for our natural resources, including oil. That being said, I can't ignore the trends, and quite frankly, even though I am an oil investor, perhaps it's smart for me just to at least be aware of what's happening in the lithium sector. And so I haven't discussed that much here on the channel, and that's exactly why I love these meetups so much, because it not only opens everyone's eyes, but it opens mine as well. I learned so much from these meetups, and so perhaps in the future, I'll take a little bit closer look at some of these lithium companies, but I thought that was just an interesting takeaway, and it is obviously clearly a trend. So another trend that we discussed was this trend towards being a vegetarian. And so I think there's probably a few things behind that trend. One is, quite frankly, the global population. And you start thinking, with the global population on the rise, there may be only so much meat to go around. We may need to find different alternatives for our nutrition. But the other trend related to that is honestly just health and wellness. I think a lot of folks these days believe that it is more healthy and that it is a better diet to try and avoid meats and stay more on a plant-based diet. And then some people, I guess the third part of the trend is they just do that for philosophical, spiritual reasons as well. They don't believe in eating meat because they don't want to put, take meat from animals. And so that is kind of the three hallmarks, I guess, of this trend, but it clearly is a trend. And I'll tell you, I watch podcasts. One of my favorite is called London Real. And when I watch the London Real episodes, there's just a lot of thought leadership there recently, especially about the plant-based diet. And so you see a lot of this also, though, reflected in the stock market. And so we were talking about the recent stock that's been highly volatile called Beyond Meat. And so literally Beyond Meat, I've never had a Beyond Meat before. And so that's why it was interesting to go to this meetup and learn that literally the value of this type of thing is it's a patty. It's made out of vegetables, non-meat products, but it tastes like meat. And so that's an interesting trend. It almost, to me, sounds I don't know if I'd even feel comfortable eating that. It seems a little strange, if you will, but I guess any new invention, that's how it is in the early days. But what was really interesting is the community member who brought this to the table was also saying that, hey, Beyond Meat is good and all, but there's another company called Impossible Meat. This one is not publicly traded yet. Beyond Meat is publicly traded, but Impossible Meat, he was saying, it tastes like the real deal. It really tastes like red meat, like a hamburger patty. But he's saying the Beyond Meat, maybe it's not quite the same as the Impossible Meat. And so the community member was saying, hey, just keep an eye on that company as well. It's private right now, but one day it might go public. And clearly this is a trend. And I know there's been a lot of drama. It's around some of these companies with lofty valuations and skyrocketing and then coming back. But again, do not ignore the trends. We'll get more into this later, but check this out. This is the holiday gift box. This is from General Mills, actually. I own stock in General Mills. If you've been following my channel for a while, I bought it when it was on deep discount. It's come back a while now. Quite frankly, in the meeting, it seemed as if some of the other community members were in similar shoes. They bought it on sale, and they're kind of happy with the returns. And so what this is it's literally a holiday gift box. And what General Mills does is it allows their shareholders to literally order this gift box for the holiday as a potential gift. But you start looking at something like this holiday gift box, and what do they have here? They're offering Chex Mix, what is that? Fruit roll-ups, Annie's mac and cheese, Nature Valley, crispy, creamy wafers, so on and so forth. And so That's more of a traditional consumer packaged goods, consumer non-cyclical food company, the type of company that I invest in. But the question becomes, hey, look, I have no intention of investing in Beyond Meat. I'll just tell you. But I love these meetups and I love the commentary. If you're not active in the comments section below, make sure to check it out because there's many opposing views and this is a good thing. I like it when people challenge my viewpoint. I like to challenge other people's viewpoints because it makes the net intelligence of the community better. And so, look, this community member brought to the meetup Beyond Meat. It sounded as if I'm not sure if he invested in it or not, but it sounded like it was a company that was well respected in terms of the mission and in terms of being aligned with trends. And I don't invest in it. I don't have an intention to invest in it, but I sure like to hear about it. I sure like to learn about it because I invest in stuff like this, like General Mills. And I just got to be careful. Hey, what does Beyond Meat mean for General Mills? And General Mills, by the way, Blue Buffalo is big in pet foods now. What does this move towards plant-based diet in humans mean for pets? Because pets these days are treated really well with Blue Buffalo and other types of pet foods. What does it mean for pets? What does it mean for my investment? And so here's the takeaway. Even if you're not a trend investor, because I'm not really a trend investor, it's important to know the trends because the trends affect any investment. Even if you don't invest in the trends, if you invest like me in more traditional companies like this, hey, be aware of the trends. And so interesting stuff. How do the trends affect General Mills? So I thought that was interesting. And one other one, boy, I like this trend because this is one. Look, I don't really want more industrials, so again, I probably won't do anything here. I own enough industrials, I really do. But unfortunately, there have been wildfires in California this year, and there were last year, and it seems to be a trend. We start seeing this more of a trend. And I'll tell you, the public utility company here, a publicly traded Pacific Gas and Electric Company, now on really dry, hot, windy days, they'll turn power off. They don't turn it off for everyone, but they assess based on your geolocation, are you at risk? And so this is a trend. And so you start thinking, I hear stories here around town. Hey, my husband is on medication that has to stay refrigerated. What are we going to do? We're going to buy a generator, or we already have a generator. Hey, I can't afford to lose, $500 worth of food in our refrigerator for the third time this fall season. What am I going to do? Hey, we're going to invest in a generator. And so I hear all this talk. And even before coming to the meeting, I was talking to my wife about this. I was like, hey, this generator industry seems like probably an interesting bet now. Now, I don't want to buy more industrials. I've talked about them at length here. I own enough. I own United Tech. I own Leggett and Platt. I own Honeywell, 3M. And I'm going to write those down, actually, because I got to remember them all for the disclosures at the end. But basically, I own all of these industrials, so I don't need more industrials. And United Tech, they're going to split into three companies in early 2020, but they own their aerospace, their HVAC, and their elevators. Do I need a generator company in addition to all of that? Gosh, maybe even through Carrier they do generators. I just don't know. But anyways, what the subscriber brought to our meeting was this company called Generac, GNRC. To my understanding, they don't pay a dividend, but obviously if one is more of a trend-based investor, hey, probably not a bad company to look at, because I'll tell you, living in California, the trend is towards natural disasters, power issues, etc. People don't want to stop their entire life because the power is out. And so generator solves that issue. And so obviously from an investor standpoint, the gears start spinning. You start thinking, hey, is this an interesting trend? And so anyways, that was kind of topic one. Look, during the meeting, we were jumping all over, but I'm trying to organize our thoughts into some main categories. And that was the first category, was just trend-based investing. And so those were some of the trends we talked about. Again, I thought it was incredibly helpful, very, very productive meeting, very intelligent group. And so another topic we talked about, and it's interesting because I didn't bring this up, but one of the subscribers, one of the community members brought it up, and I thought it was interesting. because it is the exact same topic that was brought up at one of the prior meetups in San Jose. And the topic was, Ian, team, what do you guys think of buying what you know? Peter Lynch strategy. That is my strategy, quite frankly. Peter Lynch is probably, he's one of my favorite investors of all time. It's hard to pick any one investor. Honestly, in terms of favorite investors out there, though, he's one of them. I'm kind of debating in my mind who's my favorite, because I mentioned this before, but Jason Fieber, Mr. Free at 33, he's one of my favorite investors of all time, and he's up there for me with Warren Buffett, with Peter Lynch. And so anyways, Peter Lynch, this is kind of thing he invests in, stuff you know. That's why I invest in General Mills. We've got the Cheerios at our house. We have Annie's mac and cheese. We use the products. I like to invest in what I know and what I consume. Same with Starbucks. I'm at Starbucks oh so often these days, and I always have our meetups there. What a nice location. By the way, the barista, shout out to the barista in Elk Grove. She was kind enough, it was kind of around the end of the day by the time we got out of there, and she had stuff to do behind the counter, but it took time to take a photo of all of us, and so really appreciate that. Very friendly crew out there at the Elk Grove Starbucks. I'm sure there's many Starbucks in Elk Grove, but the one we went to, that was on, I think, the Bruceville Starbucks. I forget the cross street, but it was on Bruceville. Thank you. Anyways, we were talking about Peter Lynch, buy what you know, and that's what I do. I buy what I know. And here's what got interesting, though. We started talking because different people come from different lines of work. I'm in real estate industry, but one of the attendees, he's in the lab. This is a attendee who literally works in a lab and is a PhD candidate. Very smart gentleman. Literally brought analysis to the meeting that kind of just went right over my head. And then he had to repeat himself and re-explain the analysis a few times. And then I think all of us got it, and it clicked, and it was really great. It was yield on cost. I'll talk about some yield on cost stuff a little bit later. But this is what I'm saying. If you can make it to the meetings, make it, because there is such intelligence, so much good stuff that surfaces that benefits dividend investors. Now, anyways, that same team member was saying, hey, in the lab, there are 3M products, like certain products that 3M makes. They are used in the lab. They're used for laboratory reasons. And it sounded as if, quite frankly, some of those products that 3M makes, they're pretty ingrained to the point where it wouldn't be really easy just to ditch them and go with a competitor. I heard the same thing actually from the comments section here once on PPC Ian. Again, this is why the comments are so valuable. Check them out in the description below. I heard one time that, hey, I work in the aerospace industry, and Ian, did you know in the aerospace industry, literally in the white papers and the books of parts, replacement parts for airplanes, the specific 3M parts are written in that, hey, if you need to replace XYZ, you're getting this part number from 3M. That's just how it is, because it's all regulated. It has to be done properly. And so the takeaway was, buy what you know. Yeah, it applies to General Mills, but it also applies, hey, do you have a certain profession? Do you work in a certain industry? If you do, pay attention where in your workplace. Pay attention to what you know. 3M stuff, Honeywell stuff, for example, it may show up there. And I thought that was a really, really unique insight, because it's true. I'm out there on the construction site. I've shared some photos, some video of my construction site on Instagram. Check them out. I'll link to Instagram in the description below. But I was oh so happy to see Caterpillar being used on our job site. Again, buy what you know. On our job site, I know we're using Cat. And so it's kind of obvious. I mean, that's an industrial, doesn't show up in my household on a day-to-day basis, but nonetheless, it's something I know, something I'm familiar with. And certainly the folks on the job site, the crew, they're very familiar with that equipment. That's their job. That's their wheelhouse. And so anyways, not to belabor the point, but it's always worth mentioning, it's always worth repeating that to make it in the stock market. Look, I've done really well on General Mills since I brought this up. I'll link in the description below to my original General Mills video, but it's through the roof since I started accumulating General Mills. I bought what I know. I bought it on discount. But the thing is you can do well in the stock market, both on dividends and capital appreciation, simply buying what you know. You don't have to go and buy stuff you don't know. So for example, for me, to go back to the first point, I don't know Beyond Meat. I'm don't have a passion for that kind of thing. And I'm not trying to put down the folks that do, because the team member that came to the meeting is very passionate about this stuff. For me, I don't know. I just kind of like my hamburger, and so I don't want to mess with it. I just kind of like it how it is, and so it is what it is. I'll tell you, same thing. I like cars. Like I like cars. I love cars, and so I like a traditional kind of sports car type experience where it's a traditional gasoline powered engine. That's just me. You probably you're not going to find me buying an electric car unless it's mandated or something by the government, or saying, hey, car manufacturers, you only can produce electric cars. Well, then, hey, you're stuck buying it. But for me, I'm just saying there's certain things that I'm opinionated on, and so I don't have to go invest in lithium. I don't have to invest in Beyond Meat. I don't know it. I can stick with the basics, the easy stuff, the stuff I know, and I can do really well with it. There have been numerous examples on this channel. Just did a whole video about some of the recent successes, the triumphs, the Picture Me Rolling video, the Tupac video for those of you who saw it. If not, I'll link in the description below. But yeah, that's something that I feel familiar with. But that being said, there are other people that are very familiar with things like Beyond Meat, with plant-based diet, with lithium. And so you got to stick where you know what you're doing. And so I cannot overstate that enough, because where investors run into trouble is where they go after stuff, in my opinion, that they just don't fully know. All right, so topic number 3, we talked about yield on cost. I don't want to belabor this point because this whole channel is about yield on cost. I talked about how I own Altria. My first tranche that I bought, I'm yielding simple, not even including reinvested dividends, 21% on cost. Here's the deal. One of the team members brought some really sophisticated analysis. As a team, we were talking through different stocks, and I think the data seem to support, and this is my data as well that I look at home, that yield on cost is still an opportunity. Because I think a lot of people see this channel and they're like, yeah, Ian, you got your 21% yield on cost, but I'm just starting now. Here's the deal. Even though I've been doing this over 20 years, we're all just starting right now, including myself. Why? I keep buying. So yeah, some of my old tranches have got wild yield on cost, picture me rolling, but I'm deploying money, and I got to deploy more money to be fully financially free, have my dividends cover all my bills. I got to keep going. And so I'm just starting out in that respect. And I just wanted to point that out today because I think it's a unique frame of mind that a lot of people, they're scared to start investing. They're scared to start dividends because they're thinking, oh, I missed out. Look at all these winners Ian has. Hey, he bought the General Mills. He bought it back when it was cheap. I can't possibly start now. The fact of the matter, though, is I'm always buying. I'm still buying now. Yeah, I've had success because I started a long time ago, but I have to still have success on the tranches I'm buying now. I got to get to my goal. And so in essence, in some respects, we're all starting now. And so I thought that was really interesting. But then the topic comes up, is it still possible to get yield on cost? And the analysis that was presented in the meeting basically indicated that on certain stocks, there is still opportunity to see yield on cost results like I saw on Altria, buying it way back in, I think it was in circa 2009, and I'm yielding 21% on cost. Folks buying stocks right now, 2019, looking 20 years out, there is still that opportunity for certain stocks. And 3 of the stocks in particular that came up kind of high on the list were, of course, Altria, the other one being AbbVie, which has just been skyrocketing lately. I wish it would come down a little, but I'll probably still buy more. It's still a reasonable value. And the third one, surprisingly, was IBM. And so I thought this was really interesting to consider. One, I liked that IBM kind of came up in the meeting and that met the filters, kind of got picked up as a potential high yield on cost company, because I built my full position in IBM, and I haven't really been focused on IBM that much lately. It's a company that's been having some struggles growing revenue, and cash flow is just huge. But at some point, they need to grow. But we'll contrast that, by the way, with Cedar Fair later. It's kind of a tale of two companies. But anyways, I haven't been loading up on too much IBM, but maybe looking forward 2020, I like tech exposure. Maybe I'll buy some more. And so the fact that this surfaced in the meeting, and it surfaced from the context of, hey, these models show IBM is a potential candidate for good yield on cost, it just kind of reaffirmed some of the analysis I did before, some of the things I've been thinking about, but haven't really been acting on. And so that's why these meetings are fun too. It just kind of sparks ideas and gets you thinking towards the right place. And so I've talked about yield on cost at length here. I don't want to go into too much depth here, but the key takeaway is yes, the models show, my models, other people's models show that yield on cost, it's still very real, still very much an opportunity for people buying right now, like myself, because I got to keep buying to get to my goal. All right. Another one is just dividend stocks are getting expensive. So we talked briefly about Realty Income, ticker symbol O. We talked about General Mills, ticker symbol GIS. Some of these stocks that just a year, 2 years ago, not very expensive, now they are. And so it's just something that's tough being a dividend investor right now, Q4 2019, because the stocks are expensive, but there still are some stocks that are on discount, like AbbVie, like Altria, potentially, quite frankly, IBM being a good example. 3M, maybe a little bit, not really on deep discount, but about as attractive of a valuation as you kind of see with 3M. And so the fact of the matter is, this is why I own 43 stocks. This is why I diversify, because out of the 43, yeah, you're going to have your Realty Incomes, your General Mills, which I just don't want to buy here. They're too expensive. But there are other companies out there in the 43 stocks that are attractive, that are at good valuations or fair valuations. I can deploy capital there. So that was another topic. So what I want to do now, though, is get into some of the really technical stuff. Some of you have been waiting for this. Some of you, I know you're waiting for what I already just went over because you're like, Ian, these videos have been too technical lately. But quite frankly, I'll tell you all, I'm pushing the bar here on this channel. I'm trying to make the videos as technical as possible. I'm trying to push myself as an investor, the community. I'm making the videos longer. The videos aren't as frequent, but I hope the quality is shining through because I'm trying to provide the best possible content, best quality I can produce. And so one of the community members, literally, this is what I love about this community. I get this on Twitter all the time. Ian, what do you think about the recent Starbucks dividend increase? I don't think anything about it. The first I heard of it was your tweet. That's what I love about this community is literally you all keep me in the loop. And so anyways, that's how it was in this meeting. Ian, what do you think about Cedar Fair's 1% dividend increase? I'm like, what? I don't even know about it. Let me look into it. And so I want to respond to that today. So keep in mind, IBM, we just talked about, tough time growing revenue, but the cash flow is solid. Cedar Fair, it's an interesting stock. When I first started buying it, cash flow was scaling, and it was scaling to cover distribution. I'm going to tell you up front right now, and if you're an accountant at home, I would love you to chime in the comments because maybe I'm missing something. Maybe I'm not doing it perfect. That's why I love this community. But I see a company with Cedar Fair right now where they're aggressively growing revenue, and it's working. It's working. The company top line is growing. But as a wise person once told me in my first job out of college, one of my coworkers, a little bit older than me, Ian, you cannot pay the bills with revenue, but you can with margin. And so Cedar Fair, they're kind of taking a strategy here where they made acquisitions and they're just quite frankly just developing real estate. They're building hotels. They even built a whole huge sports complex outside of Cedar Point with all these fields like football and soccer and baseball, all these fields, indoor arena as well. They are making these investments. As they make these investments, margins, cash flow, it hasn't been really good the last few years, and especially so far in 2019. But 2018 wasn't very good either. 2017 was good, or reasonably good. We'll talk about this. I'm going to show a lot of numbers on the screen. But I love these meetups because it gets me thinking, why? Why did they increase the distribution just 1%? Especially when I saw a corporate deck that told me they were going to target 3 to 5% ongoing in perpetuity. The reason they did 1% is they've taken on a lot of debt. They want to pay it down. They have a huge amount of capital expenditures now because I think with the Schlitterbahn acquisition of these water parks, they put in renovations. They've improved upon stuff. They also acquired another park. I forget its name right now. In 2019, and they're making improvements. Great America, they bought out the land underneath it because it was on land lease. That is very valuable. But what has happened, also, I would say operational profits have, cost of operating their parks has been high. And so we'll get more into all the numbers, but I want to paint the picture first what's going on with Cedar Fair. The reason the distribution is slowing, the growth, is because they're consciously focused on growing revenue now. They're doing it at the expense of margin. My calculations show me that the margin, the cash flow, doesn't even cover the distribution in 2019. Far from it. And so this is intentional. They're doing it on purpose, but it can't last in perpetuity. You cannot pay the bills with revenue in perpetuity. You pay them with margin, with cash flow. And so I want to point out the numbers because I have to be realistic with myself, with the community. It's still a top 15 stock for me. And quite frankly, I'll probably buy more of this next week. I may buy more of it even before this video goes live. And so if I do, check out my Twitter. You'll see my transactions there. I always post them on Twitter. And I am the kind of investor, especially with a smaller company like Cedar Fair, I realize it's not just straight up and to the right. There's peaks and valleys, and there's different metrics. I can see what they're doing now. They're creating a competitive moat, if you will. They're really solidifying their fortress. They're expanding upon the business. They're doing this in many ways. But short term, and they're doing that probably because the cost of debt right now is really low. We'll talk about that too. But it can't, and it's good, but it can't go on forever. But I'm taking the risk. Stock's down from its high, way down. Starting yield, 6.7%. For a 6.7% starting yield, which quite frankly has tax advantages because it's an MLP, it's hard to do the taxes, it's tricky, but there's advantages that flow through to the unit holders like myself. I'm willing to take on risk, but there's no doubt about it. Within my portfolio, it's a smaller cap company. There is risk, and there's risk because the cash flow right now, it's not covering the distribution in 2019 because they're growing. They're growing revenue. They're making acquisitions. They're making capital expenditures. And so I'll have to watch it. I'll have to watch it in the future. But this is just how it goes as an investor. And you have to find as a risk tolerance level, where do you lie? I'm okay with my risk tolerance because I got 43 stocks. I diversify. Cedar Fair top 15. I feel that they're doing this consciously, so I'm okay with it. All right, so I want to just pop some stuff on the screen there. What's going on with Cedar Fair? The price per share right now is $55. It's come down a bit since they said we're not going to allow Six Flags to acquire us. Thug Life, thank you. By the way, I'll do an analysis sometime on Six Flags. I know a lot of you want it, but I'm glad they're not being acquired by Six Flags. Recent high was as high as $61. Just recently on the Six Flags news, they're down to 55. So they're down about 10. What is that? About 10%. And so the distribution per quarter is now 93.5 cents. It was 92.5 cents. And so literally it's up 1.1%. The last increase, by the way, was from 89 cents to 92.5. This is the quarterly distribution. Last time it was up 3.9%. And so I was expecting another 3.9% increase or thereabout. That being said, now that I've seen the numbers, I'm glad they didn't increase it more than 1.1. They got to figure out the cash flow, and I'm hoping the capital expenditures come back to reality in 2020, 2021. They should, as long as they don't make more and more acquisitions. Hopefully they're done with acquisitions for now. Okay, so the distribution per year is $3.74. That's what happens when I take 93.5 cents, I multiply by 4. If I take that, I divide by the share price, I actually get a distribution yield of 6.8%. So what I was just saying, 6.7, that was actually at the old distribution level. At the new distribution level, 6.8% yield. So again, juicy starting yield for a pretty well diversified traditional real estate company. And so the 5-year compound annual growth rate of the distribution is a 4.5%. So obviously the 1.1% growth is a lot lower than that. And the market cap is $3.1 billion. This is really worth emphasizing. In the scheme of companies I own, this is one of the smallest, if not the smallest. This is a smaller cap company. And with a smaller cap company, it will go through more phases. When they make acquisitions, they make big CapEx, it will affect the bottom line. Much more so than a big company like 3M, which made a big acquisition earlier this year. Not going to affect them the way an acquisition will affect Cedar Fair. Okay, so I'm going to show the numbers on the screen. I look at the earnings, and I'm looking at year to date through November 3rd. Everything is up. They show with Schlitterbahn, without Schlitterbahn. Net revenues are up 9% with Schlitterbahn. Without that, it's up 6%. Attendance is up 7% with the new parks, up 4% without the new parks. In-park per capita spending's up 2% with Schlitterbahn, up 1% without. Out-of-park revenues are up 10% with Schlitterbahn, 7% without. I love this out-of-park revenues category because this is where they're building hotels, nearby attractions. For example, the sports park, for example, that out-of-park revenue is bolstering this company, and it's involving a lot of CapEx, a lot of investment in the short run, loans as well, debt, and it's paying off for the company. So it's nice to see all of that. Let's see. So the third quarter net revenues. Oh, this is just the third quarter, not year to date through third quarter, but just third quarter. The with Schlitterbahn is 8% growth, 7% without. So again, consistent. And they hit a record $715 million quarter. All right. So I want to look now at this adjusted EBITDA number. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. This is a way that the company looks at their numbers to kind of take mostly, I would say, depreciation out of the picture. Being a real estate company owning parks, they're able to depreciate their assets for tax purposes. And that messes with their EPS, with their GAAP earnings per share. And so looking at it this way, it's a little bit of a better way to look at it. It just gives a more realistic picture. That being said, I look at it even differently. I take their adjusted EBITDA, but I try to back into a real cash flow because I know in that EBITDA, you're leaving some stuff out. You're leaving out CapEx, which is legitimate expenditures they have to make to improve the parks and to refurbish stuff, to invest in stuff. It leaves out interest expense, which is legitimate. They have interest expense to pay on their debt. They got a lot of debt. And there's this provision for taxes. While most taxes for this entity flow through to the unit holders like myself, my understanding is some of the taxes are paid at a corporate level. I believe it's probably taxes related to property tax, if I had to guess. Accountants out there, I'd love to learn more what you think about this provision for taxes for the MLP structure. But basically what I do, you'll see it on the screen, I back into the real cash flow. I take their adjusted EBITDA, but I subtract out, that overstates their earnings big time because it doesn't account for CapEx, doesn't account for interest, doesn't account for taxes. And so if I subtract all those out, what I'm left with is Ian's cash flow proxy. And you can see in this is comparable first 9 months of 2018 versus first 9 months of 2019. It's down 76%. So everything looks good. Like I said before, revenues are up, attendance is up, adjusted EBITDA is up. But you know what? CapEx is way up. It went from 145.7 million to 296.6. So that's way up. Interest expense, it's only up a little bit. I'm not worried about that. Provision for taxes are up as well. And so when you look at that, especially the CapEx, it throws off the true cash flow. And so when you look at the true cash flow, it's down. First 9 months of last year were 158 million. First 9 months of this year, 38 million. And so 38 million, by the way, does not cover the distribution. We'll get more to this in a minute. And so the way I look at this, again, is as I said, they're making investments in the company, in the parks, in acquisitions, and revenue is doing fine, but you can't pay bills with revenue. So all the way down at the bottom line, my cash flow proxy, it's not covering distributions at this point. But for my 6.8% yield, I'm taking the conscious risk as an investor, and I'm actively buying more here that this is just 1 year or a few years in their longer journey, and they're setting the stage for better margins ahead by making these acquisitions and digesting them. Something really interesting to point out in the life cycle of a business. And so I want to jump now to more numbers. And so if you have been here a while, you'll know I did a video on Cedar Fair a long time ago. And I posted a huge financial analysis. You could still download it. I'll put link in the description below to that video where you have info on how to get it. I'm just going to show it on the screen here because I updated it through 2018. Now, I could not do 2019 yet because this relies on their annual report. I'll just wait for their 2019 annual report. But last time it was through 2017. Now it's through 2018. And it gives you a sense of how how much the distributions cost the company versus my cash flow proxy. And so that's what I want you all to see. What you can see in this analysis, when I start out just with the income statement, is revenue's doing fine. It's up, up, up. Even if you look 2013 through 18, each year pretty much, it just keeps going up. So again, you can't pay the bills though with revenue, but at least the company is scaling. And when you look at something like operating income, though, it's kind of more flatlined. Operating income is not growing as quickly as revenue is scaling, especially in the last few years. And so that's the first red flag. And look, I think it's important, even when you own a stock, even when you like it, you believe in it, like I do with this one, nothing is perfect. You've got to know the red flags. At this company, the biggest red flag I see is the revenue scaling, but the margins, the income, the operating income, it's not. And so cost of running this business it's going up. Anyways, operating income is kind of flatlined a bit since even 2013. You can see 2012 to 2013, it jumps. And so, but if you look 2013 through 18, it's basically been flat as they've been scaling their revenue. And then you can see in income before taxes, boy, that's even more compelling. That's kind of all over the map. I guess you had big years in 2016 and 17, but quite a bit down in 2018. Now, mind you, 2018 is a weird year, as is 2019, because they're starting to make some really big investments. 2019 was the year of acquisitions, but even in 2018, I know they're making some pretty big investments in their existing properties. Okay, so what else do I want to look at here? I'm not going to look at everything. Shares outstanding here, by the way, is not pulled from anything. I back into it. The way I back into it is I take the net income and I divide by the net income per share. It's not perfect, but it's very close. And the distributions, you can clearly see scaling. It goes up from $1.60 in 2012 to $3.60 in 2018. So distributions are scaling, which is what compels me as a dividend investor. But it also, I have to realize those can only scale as they grow margins, not revenues. And so they better see some margin growth in coming years. And I think they will. So you see your adjusted EBITDA here. That number is pretty consistent, quite frankly, the last 4 years. It's up since 2012, 13, and 14. And so you see that. And you see CapEx coming in pretty consistently growing, but you don't see it here, but in 2019, huge CapEx. So and you see attendance, by the way, steadily growing. It's growing really nicely. And in-park per capita spending growing nicely. So few things to point out here. One, let's just look at the interest expense. A lot of people get concerned with a company like this. It has debt that's in the real estate space. Interest expense, is it overwhelming? It actually is not. If you look at the interest expense, it's only $85 million in 2018. It's actually down from 2013 and so 2014. And so interest expense, I would say it's contained. It's going to go up now with Schlitterbahn and these new acquisitions for 2019. But more or less, it's contained, and it seems like they have a path towards paying it down. So that was just something I want to point out, though, because a lot of people with a company like this, they don't even look at it because they're concerned when they look at the debt level. But it's not only the debt level, it's the interest. It's the interest associated with that debt level, which is not overwhelming here, as long as rates stay low, which I think they will. Rates go up, you got a whole nother story. And so, as you do for most companies. So provision for taxes, you could say 2017 was an anomaly. They had no provision for taxes. 2018 back to normal. 2016 was high. 2019 is looking more like a 2016. So it kind of goes all over the map, but you see that perhaps this provision for taxes is related to the acquisitions. Perhaps it's related to property tax. I don't fully know. If you're an accountant, I'd love to hear what you think it's related to. I could dig in the annual report even more, but at a certain point, I got to take a step up and not get caught in the analysis paralysis. Here's your depreciation and amortization, 155 million in 2018 versus 126 in 2012. So that's really that's what really, in my opinion, throws off your GAAP earnings on something like this, because the depreciation, it's not real. They're not really losing money there. But that's how it would look if you just look at their raw EPS. That's why I back into my cash flow proxy. Anyways, you check out my cash flow proxy. And again, what I do is I look at adjusted EBITDA, but then I subtract out interest expense because that's real. I subtract out provision for taxes, that's real. And CapEx, that's very real. And what you see here is, and I also have distributions right below it. And the way I get distributions is I just take the number of shares outstanding and I multiply by the distribution. You could see even in 2018, this is the new data. This is data I just added for the analysis today. They come up short. They come up about $50 million short. 2017, which is the last year when I did my last analysis, they basically cover the distributions with the cash flow. That's what I like to see. I want to see years like 2017. 2016, they come up short, but when I did the analysis before, I kind of took it with a grain of salt because I'm like, look, it's one of the only years where they're coming up short. 2015 covers the distributions, just barely. That's what I like to see. 2014, hey, they're under by 1 million. Fine, close enough. 2013, they more than cover distributions. 2012, more than cover it. 2011, 2010, they actually cut distributions back then big time. And the reason is they made the Paramount Park acquisition and they wanted, I believe, to use money to pay down debt. And just to be careful during the Great Recession versus paying out too much distribution. And so I commended them, if you remember, in my last video for being prudent with their cash management. Very prudent during the Great Recession. And so the news, it's so funny. Taking a step back, we have a meetup. Someone brings in the news. They only raise the distribution 1%. It gets me thinking. It gets me looking at all this stuff. Leads me down this path that, hey, what's going on really here? Oh, something's changing with the cash flow. My cash flow proxy, even through 2018, the cash flow proxy is not covering the distribution. And then I fast forward again to 2019, and they're only bringing in 38 million cash flow proxy for the first 9 months of the year. Whereas those comparable 9 months were 158 last year. And I know last year they did a total of 157. So it looks like there's no additional cash flow coming in Q4, which makes sense because this company doesn't make a lot of money off season. It's a seasonal company. So quite frankly, this 38 million may be the cash flow they receive this year. Certainly doesn't cover plus or minus 204 million in distributions. And so you start thinking 204 million distributions, 38 million cash flow. They're digging a hole here. And so, again, I don't get too concerned, but if this is a trend for the next 5 years, something's got to give. If this is a one-time trend because they're making a lot of acquisitions, fine. This company is at an inflection point. Kind of like AbbVie, patent for Humira is expiring. PE on the company is really low. A lot of people are worried about it. Stock price is down because they're going to lose revenue and earnings and margin because of that expiration. The question is the Allergan acquisition or all these new products going to fill the gap quick enough? Who knows? But it's a fork in the road for AbbVie. I'm taking the risk and I load it up. It's already paying off, but time will tell if it really pays off. It's been only not too long here. And so Cedar Fair, different reasons, same thing. Fork in the road. Are these acquisitions going to pay off? They did with Paramount, by the way. Back in the day when they made Paramount, it was very risky. It paid off. Is Schlitterbahn, all this other stuff going to pay off? Looks like it could from a revenue standpoint, but I don't know from earnings. And so the question is, I'm making the bet. I'm buying it just like I am with AbbVie. There's some level of risk in some of the investments I make. That's how I get huge yield on cost. That's how I get huge cash flow. I can go with the tried and true, the easy stuff, the Honeywells of the world, but my yield on cost for Honeywell, it's never going to be huge, but it's always going to be a stable, steady Eddie anchor in the portfolio. I like having those types of companies. They play a role in the portfolio. But I also have riskier companies in the portfolio like the AbbVies and the Cedar Fairs of the world. And so it's just interesting as an investor to think through all of this. And the main takeaway I want to give all of you, take the financial stuff seriously because it's important, and just be honest with yourself. I have to be honest with myself. I love this company, but I'm not going to sugarcoat it. The distribution right now, it's not covered. It's not covered by the cash flow, and time will tell if they figure that out. I think they will, and I'll make that bet. So before I go, I want to share just a few more screenshots on the screen because this is important for everyone to see. You may be wondering, where am I pulling all of this information? So first and foremost, go to their website. By the way, they have a really awesome corporate deck on their Cedar Fair Investor Relations website. Scroll to the bottom of the page. They have a cool PowerPoint. But I'm just going to show just where I'm pulling some of the numbers. And so what you see on the screen right now is their income statement for the 9 months ended September 29th, 2019. So this is the first 9 months of the year. And it shows the comparable 9 months for 2018. And so you're wondering, where do I pull some of these numbers? It's right here. And in particular, I used this to pull the revenues, the depreciation and amortization. I used this to pull the adjusted EBITDA. And you could see, hey, adjusted EBITDA. It's a pet peeve of mine. You see this a lot at tech companies, tech startups. They use this EBITDA, and EBITDA, honestly, in my opinion, is kind of a joke. And so I don't want to put down my management team at Cedar Fair because shout out, I love you all, thug life. But this is why I take adjusted EBITDA and then I subtract a few things out to get my cash flow proxy, because my cash flow proxy is a more conservative, better way to look at it, because that shows, hey, is the distribution covered or not? And it's not. Adjusted EBITDA would lead you to believe they've got all the money in the world. And so anyways, attendance is here too. You can see attendance went from 21 million up to 22.8 million. So I love that. That's really cool. Okay, so that's the first screenshot. I want to show you another screenshot now. And this one is the, what is this one? The income statement. And so this one again, I guess this is just the same thing, but it's showing 3 months and 9 months as well. And so again, I'm pulling revenues here, I'm pulling costs, and let's just take a look at this. What the heck? The costs have to be going up somewhere. Let's see where these costs are going up. I'm going to look at the 9 months. It looks like food is up a bit, operating expenses is up a bit, SG&A, selling general and administration, is up a bit. Depreciation is up, but not much, and that's actually helpful. I want to see that go up. So what you see here is, why are the margins squeezed, quite frankly? It looks like you got a big jump in operating expenses, big jump in SG&A, probably, quite frankly, related to these acquisitions. I wouldn't be surprised if they've had to hire a bunch of consultants, investment bankers, this and that, to push through acquisitions. These guys are expensive. These are the kind of people, these investment bankers, they're pulling in 500,000 million a year. That's their salary. And so, hey, that's probably where some of this money is going. And so that's just interesting to see. Anyways, this gives you just a picture. I like the breakdown here. It gives a picture of what's happening with their margin. I'll keep an eye on this in the future. I want to show one more screenshot, and this is the cash flows one. This one's important because this is where I picked a few more of the data points. And so let's look at this. For the 9 months ended, it shows my CapEx here. This is really important. CapEx jumps from 145.7 up to 296.6. And it clearly, and it shows here, look, distributions kind of right in that level. Not, again, my analysis that I showed before is not perfect. I was backing into certain numbers, but shows you the distributions here. It's about 157 million through the third quarter. It was 150 through the same the last year, and so that's very consistent with what I would expect. Anyways, I just wanted to show these quickly because these are the financial statements that help me do my analysis. All right, everyone, another fun video. I know is a bit jumping around, scattered on the Cedar Fair stuff, quite frankly, because it's complex. Analyzing Cedar Fair is a lot harder than analyzing Honeywell, but I love it. I got to do it. Community challenges me. I challenge the community. That's how this works. We all become better investors. That's the point of all of this thug life. And so before I leave today, in terms of full disclosure, I am long the stocks I mentioned today. I own Chevron, ticker symbol CVX, Honeywell, ticker symbol HON, 3M, ticker symbol MMM, AbbVie, ticker symbol ABBV, Altria, ticker symbol MO, IBM, ticker symbol IBM, Realty Income, ticker symbol O, General Mills, ticker symbol GIS, Cedar Fair, ticker symbol FUN, Starbucks, ticker symbol SBUX, United Technologies, ticker symbol UTX, Leggett & Platt, ticker symbol LEG, and Caterpillar, ticker symbol CAT. Before I leave, in terms of a full disclosure, I'm not a licensed investment advisor. Today's video is not investment advice. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. More disclosures in the description below, by the way, as always. I love you all. Thank you to the 4 subscribers who made it to Elk Grove. I love you guys. I had so much fun. I cannot wait for the next meetup. I'll do another one in Elk Grove or greater Sacktown area. I know there are a few people couldn't make it. We will do it again. I still owe meetups in Bay Area, a few of them in the Bay Area before the end of the year, and possibly Los Angeles as well. Shout out to all my LA Thug Life investors. All right, everyone. Thank you again. Please subscribe, hit that like button if you enjoyed the video and you want to support the community. I will see you in the next video.